Hello, and welcome to the 21st episode of Who Said What. Thanks for tuning in every week. I am Krishna, and this is the show where I dive into interesting comments made by notable figures from across the world, whether it's finance or the broader business world, and dig into the stories behind them. Today, I have four very interesting comments from Arvind Subramanian, Dipinder Goyal, and a few other people. In the recent episode of the India Briefing podcast, former Chief Economic Advisor Arvind Subramanian shared his thoughts on the Indian economy. But what really stood out was what he said about India's informal sector and where it's heading. He pointed to three big blows that have hit the informal sector over the past 7 to 8 years: demonetization, GST, and the COVID 19 pandemic. GST, in theory, was supposed to push businesses towards formalization over time. But when you combine it with the other two shocks, the informal sector has taken a real hit. At the same time, Subramanian notes that India has quietly built what he calls a reasonable welfare state. It started with UPA 2's Food Security Law and Manrega and has continued under the current government's new welfareism: cash transfers, cooking gas, electricity, bank accounts, toilets, etc. According to him, this safety net has softened some of the pain for the informal sector, describing it as a quasi-opiate of the masses.
If there's one thing that's been true about India in the last 20 years, ever since UPA 2, is that we've done a reasonably good job of building a welfare state. It began with the UPA 2, with the Food Security Bill and Manrega. And then also, then under this government is what I call new welfareism, which is, providing cash transfers, providing, cooking gas, power, electricity, bank accounts, toilets. And of course, now you could say this is either a cancer or a cure, the proliferation of cash transfers. So what has happened over the last 20 years, I would say, is that India has built a reasonable welfare state. So at least, in terms of these three shocks that happened, there was some compensation in terms of creating this welfare state, which without doubt has benefited a lot of people. And I would argue, again, relating it back to something else that we spoke about, the fact that overall GDP growth has not been great. I mean, part of the reason why I think we haven't seen a more restive population or a more kind of, mobilizing population is partly this welfare state. I mean, I wrote a piece somewhere saying that this is kind of the quasi-opiate of the masses now, that, this welfare state that we have.
What's important is that Subramanian doesn't see informality as some kind of hidden strength or charm of the Indian economy. He flat out calls it a pathology. He compares India with East Asian countries like China, Korea, Taiwan, and Vietnam, where development happened by moving workers out of low-paid informal jobs into formal sector work with better pay and projections. One of his most striking points: according to the latest PLFS data, less than 15% of India's workforce has a steady formal sector job. As he puts it, that's a failure of our development model.
If you look at the labor force, if you look at the latest PLFS, I think I would say even less than 15% are in regular formal sector jobs, regular salaried formal sector jobs. And that's just a failure of our development model, much more broadly. That's why we're not like Vietnam or Korea or Taiwan or whatever. And that's kind of a bigger conversation about why that happened and how it needs to be fixed.
He lays out three moments when India could have become a major manufacturing hub. The first was right after the 2008 global financial crisis, when China started to shift away from labor-intensive manufacturing because wages there were rising. The second was the Trump geopolitical shock, when the US and other Western countries began looking for alternatives to China. And now we are in the middle of the third. With tariffs and geopolitical tensions piling up against China, global companies are again looking for other options. But here's the catch. India missed the boat for first two times, and countries like Vietnam took the lead. Apple's investment in India are more of an exception than a sign of broad success. Subramanian points to apparel sector as an example of India's potential. Right now, India is about 3% of the global export market in apparel. China at its peak controlled 40 to 45%. He thinks India could realistically aim for 10 to 15% share.
If you look at the global, India's export market share in apparel, it's about 3%. China's was 40%, 45%. why can't we go from 3 to 10 or 15%? We'll never go to 20%, but why can't we get and that means lots of jobs for women, because apparel is very, very female intensive employment.
And that growth matters. Apparel manufacturing is known for creating lots of jobs, especially for women. So, what's stopping India from grabbing this opportunity? His take is a little blunt. Investors don't just want tax cuts or subsidies, they want to feel safe. He says investors are worried about the weaponization of enforcement, overzealous regulators, arbitrary treatment of businesses, and tax harassment. And according to him, these fears are showing up in the numbers. Foreign direct investment is falling and private investment is stuck, even though the official growth rates are high.
My only observation, which is a bit controversial, is that all that the government is doing on the political side, the weaponization of enforcement, the arbitrariness, the favoring of some, big businesses over others, the fact that there's a lot of tax harassment, the regulatory, overzealousness on the regulatory front. These are things that actually really raise risks to investors.
He also talks about two other development ideas floating around. One is from Rohit Lamba and Raghuram Rajan, who suggest focusing on IT services, but Subramanian points out that this would only benefit about 5% of the labor force. The second comes from Danny Roderick, who argues for raising productivity in non-tradable services, essentially making the informal sector more productive. But Subramanian is skeptical. He points out the limits of small informal businesses.
But then, as you know, there are at least two alternative development models on offer. One, Rohit Lamba and Raghu have said we should focus on IT services and so on. I mean, by definition, you're not going to get inclusion on that. IT services are 5% of the labor force. You're not going to get that. A little bit more interesting, I think Danny Roderick has new ideas on, basically, can you boost the productivity in non-tradable services, like the informal sector? Can we somehow get them to become more productive? Because by definition they'll be more inclusive, because you're affecting the entire population, because the bulk of the population is employed in informal non-tradable services. So somehow if you could get their productivity levels up, maybe you can get both growth and inclusion. I have some reservations about that as well, because the history of by definition, if you have a mom and pop shop, a small shop, there are limits to how much more productive it can be and how productive it can be over time.
Now, the question lies, where do we go from here? Despite the challenges, he is still hopeful. He believes India has a real shot in manufacturing. If it can create a business climate where investors feel the risks are under control, he points to Tamil Nadu as a success story, where the state has managed to balance the interest of workers, businesses, and the government to build a much healthier environment for manufacturing.
And I think Tamil Nadu has done a good job on that in really kind of creating a climate where business, once it comes in, it can be somewhat reassured that all actors will work to kind of minimize and troubleshoot together, as it were. That it's not that business will not be left on its own and will have to cope with all the cope both with the capricious state and with other actors. So the state needs to be both not weaponizing its enforcement and not being arbitrary, but it also needs to be a good interlocutor when it comes to labor disputes, for example. It has to be kind of labor, capital, and the state coming together, and that's been happening in Tamil Nadu as well, where labor strikes and they all come together and sort it out.
Even though India missed earlier waves of manufacturing growth, it still has a window of opportunity. If it can grab a bigger share in the sectors like apparel, it can create formal jobs and start tackling the long-standing pathology of informality that holds back inclusive growth. So we recently started something called the chatter. The idea is basically we go through the earnings call of companies, big or small, it doesn't matter to us, and pick out the most interesting and the most insightful comments. We were doing this for the stories on the daily brief, but through chatter, it gives us a wider scope of learning more things and connecting together ideas and bringing them all together to you. I'll link the newsletter in the description, but in listening to all of these con calls, I came across a bunch of interesting things that the management is saying. One such pattern was about how the consumers aren't spending much, the shift towards quick commerce, and the muted growth for FMCG and big retailers. Let me take you through what's been happening in detail. See, when you carefully listen to what consumer company CEOs across India are currently saying, the reality beneath the headline growth figures becomes increasingly clear and quite worrying. Consider Mohit Khattar of Gravis Foods, the group behind Baskin Robbins in India. As you know, this year summer arrived early, bringing intense heat conditions seemingly perfect for ice cream sales. Yet he described their recent growth, roughly around 20%, as underwhelming in an interview with Business Line. At first glance, 20% might seem healthy, but the concern lies deeper. He explains that consumer behavior is shifting dramatically. Instead of visiting ice cream parlors or using traditional food delivery apps, customers are rapidly moving to quick commerce platforms like Blinkit and Zomato. Dipinder Goyal, CEO of Zomato, echoes similar worries in their recent shareholders letter. Zomato recently faced a pronounced slowdown in food delivery growth, and he identifies three reasons behind the slump. First, overall consumer spending is weakening, especially in discretionary segments. Consumers are cautious, perhaps because their real incomes aren't rising or because their confidence about the future income stability is low. But what's causing all these stagnant incomes? A report from Reuters suggested that real incomes for Indian households, particularly among the urban middle class, have been stagnant or even declining once inflation is considered. Even a recent report from DSP highlighted how salaries have slowed over the years, which might mean that people are a little more cautious about spending. The second thing that Dipinder says is that there's been a shortage of delivery partners, with many shifting to Zomato's own sibling Blinkit and other quick commerce platforms offering slightly better immediate pay and more predictable work. This labor shift not only creates a temporary supply crunch but could structurally raise labor costs over the long run as platforms compete for limited workers. Now, some may argue that the wages they make are still low, but that's a discussion for another day. Lastly, he says that quick commerce services themselves are stealing market share as consumers increasingly prefer instantly delivered packaged foods over restaurant meals with longer wait times. But how is this shift entirely new? Now I don't know for sure, but I came across this interesting data point from Data for India. It showed that historical spending data indicates Indian households have steadily increased their preference for packaged foods, rising from about 8% in 1988 to roughly 23% by 2023. Now this number would have only grown, more so because of the QC platforms. Avenue Supermarkets, which runs DMart, faces related pressures. Their CEO Neville noted recently in their earnings call that despite solid revenue figures, DMart margins have fallen a bit. He attributed this margin erosion to intensified competition within FMCG, rising wages due to persistent labor shortages, and significant capex in new store expansions and enhanced customer experience initiatives. Bunch of similar reasons to what Dipinder Goyal said, especially about the labor shortages. Now, investor sentiment mirrors these concerns. Looking at the Tijori FMCG index, market leaders like HUL, Britannia, and Godrej Consumer Products currently trade significantly below their recent highs, reflecting cautious investor attitudes. Investors, seeing weak consumer demand and compressed margins, question whether traditional FMCG companies remain resilient or if these structural changes fundamentally alter their investment appeal. QSRs or quick service restaurants further illustrate cautious consumer behavior. Chains like Domino's, McDonald's, and KFC have struggled with stagnant or negative same-store sales growth over recent years. But what's driving consumers away from high-value offerings towards cheaper deals and discounts? Price sensitivity driven by stagnant real incomes and heightened economic uncertainty makes consumers cautious about discretionary spending, compelling restaurants to rely heavily on promotions and value-oriented menus to attract foot traffic. Further deepening the narrative is India's stark wealth inequality. A detailed Hindustan Times analysis highlights how sharply wealth remains concentrated. The top 1% of India's population holds nearly 40% of nation's wealth, while the bottom 50% collectively owns around 6.5%. Such inequality significantly restricts mass market disposable income, creating a structural barrier to broad-based consumer spending. Understanding India's consumer economy today requires recognizing both structural and cyclical shifts. Structurally, digital first shopping habits, rapid adoption of quick commerce, and changing consumer preferences toward convenience are reshaping markets permanently. Cyclically, high inflation, stagnating real incomes, weak job creation, and cautious spending behaviors compound these structural shifts. Companies across these sectors are responding by becoming more cautious, prioritizing operational efficiencies, profitability, and customer retention over rapid, unprofitable expansion. Now, I don't know where we are headed, but it will be interesting to see how this evolves over time. Now, on to the third comment. See, coffee prices have gone up quite a bit. Around 3 years back, it was roughly $1,800 and now it's $5,000 plus. Tata Consumer Products, the largest coffee operator in the country, and CCL Products, one of the largest coffee exporters in India, said a few things around coffee prices. Let me bring them all to you. At Tata Consumer's latest earnings call, management couldn't hide their surprise at how far beans cost have run. The management said that I don't think we can draw a trajectory or we can plan a forecast on where coffee prices will go. They admitted, recalling how futures briefly tumbled from $4.3 to $3.8 before shooting back up. There are two things freaking everyone out right now. First, this year's coffee harvest in Brazil, that's mostly Arabica, and Vietnam, mostly Robusta, aren't looking as healthy as usual. These two countries are the largest coffee producers in the whole world. So if things go bad here, it affects the price of your coffee. And second, even the big buyers aren't locking in prices for the long haul anymore. They're only hedging for short bursts, all because of uncertainty. Now, this volatility isn't just a talking point, it has real profit consequences. The CFO of CCL Products meanwhile painted an even starker picture of the input cost squeeze that I mentioned at the start. The benchmark price for raw Robusta has gone from $1,000 a ton between FY 15 to 20 to $5,000 now. That's a 5x jump. This has caused a jump in borrowing for working capital. Yet he also warned that it's not high prices per se, but their unpredictability that causes the worst headaches. He says that what really hurts is choppy prices, not high prices. If prices stabilize even at today's high base, customers go back to longer contracts and our working capital cycle and inventory days shrink. So overall, there seems to be a lot of uncertainty right now in the coffee business. Now for the final comment. Kashish, our in-house banking expert, wrote this story. He made sure that all of you know this. In the latest earnings call, IDFC's FIRST Bank CEO V. Vaidyanathan took a bold stance defending the bank's latest 7,500 crore equity raise. He acknowledged that this move dilutes existing shareholders by about 15%. He framed the question on everyone's mind, why raise such a large chunk of capital now? He says, I must say that indeed, we have seen some reports and reviews saying that look, you people have raised 15%, diluting the bank by 15%. Why was the need to raise that large amount of capital in the first place? Now, it's a very fair question. Now, this is the fifth capital raise since 2020. 2,000 crores in 2020, 3,000 crores in 2021, another 2,000 crore, then 3,000 crore, and now 7,500 crores in 2025. That's a lot of new equity. It needed some explaining. His answer was quite striking. He invoked the early growth story of ICICI Bank, one of India's most successful private banks. ICICI, he noted, also began life as a development financial institution, just like IDFC First, and had to raise massive equity in its initial years to become what it is today. He said the bank raised $2 billion in 2005, $5 billion in 2007. That's $7 billion. That's how institutions are built. Vaidyanathan pointed out that ICICI Bank's return on equity was low in those days, necessitating big capital infusions. But eventually, ICICI started generating 16 to 18% ROE and is flying on its own today, without needing constant funding. In other words, IDFC's first CEO is telling stakeholders we're following the same playbook. Raise money now to fix the foundation, like ICICI did, and the profits will come in later. To put this in context, IDFC First Bank was born from the merger of IDFC, a loss-making infra lender, and Capital First in 2018. It inherited a legacy portfolio of infrastructure loans and a minimal deposit franchise, not exactly a recipe for instant profits. The bank was essentially in a catch-22 situation. As Vaidyanathan explained, if you spend money you don't have the operating profit to spend, you can't fix the CASA. If you don't spend, you can't fix the issue. This was really a hard problem to solve. So the bank chose to raise capital. again and again to escape the trap. Vaidyanathan described it simply. We found a way to raise capital and then with the capital we built the bank. Since the bank couldn't rely on meager internal profits, it used external capital to expand its branch of network, improve technology and ramp up its deposit base, even at the cost of short-term profitability. He says we have grown the deposits from about 38,000 crores to 2.4 lakh crores, CASA ratio close to 47%, branches about 1,000, loans and advances 2.4 lakh crore, so you get the drift. And to be fair, that is a substantial transformation in 6 years. From a weak deposit base and expensive borrowings, the bank now has fairly diversified funding structure. Vaidyanathan openly acknowledged that IDFC First has diluted equity every single year since the merger, and he isn't apologetic about it. In his mind, it's all part of a bigger picture. The bank's trajectory, he said, resembles a J curve, a deep initial loss followed by a sharp profitability rise. He says, our first stop is to actually move ROE from 7% to 15%. We really intend to do it. The numbers back this arc. From 1944 crore loss in FY19 to 2900 crore profit in FY24 before falling again to 1500 crore in FY25 due to a microfinance blip. Still, the core bank has operating profit margins of over 2%, and with microfinance provisions expected to ease, management is confident of a smart recovery in FY26. In short, the message is spend now to build scale, reap profits later. Now, ICICI Bank did indeed raise massive capital in the mid-2000s. $2 billion in 2005 and $5 billion in 2007 and used it to expand rapidly. Its share count nearly doubled from 170 crore to 300 crore by 2009. Eventually, it began generating high ROEs and didn't need fresh capital to grow. In that sense, the analogy is fair. Bold investment in the early years paid off. But there are important differences. ICICI raised money in a pre-2008 era of global liquidity and had a first mover advantage in private banking. IDFC First, meanwhile, is competing in a much more crowded and regulated space, and the comparison leaves out another model, HDFC Bank. See, HDFC Bank grew differently. From day one, it maintained high ROE, clean asset quality, and didn't dilute equity year after year. It raised capital occasionally, once a decade even, and funded growth largely through profits. This was slower but more sustainable. That contrast matters. Vaidyanathan is betting on speed, grow deposits, branches, tech, and loans fast, and worry about ROE catching up later. HDFC took the opposite view. Build profitability first, then scale. Both paths can work. One's just more forgiving than the other. Now, not everyone is convinced by Vaidyanathan's narrative. An investor posted this sharp critique on Twitter. He pointed out that the bank raised 3,200 crores from LIC and another 7,500 crore from Warburg Pincus and others, over 10,000 crore in fresh equity in a single year. His central point is that the bank is growing fast but not profitably enough. He calls it unprofitable growth. ROE stuck, the bank's return on equity was just 10% in FY24 after years of being lower. Net worth is driven by dilution. Since FY20, 70% of IDFC First net worth increase has come from equity raises, not profits. Another thing is spending remains high. 400 crores on cricket sponsorships, 200 crores in dividends, while ROE is still low. Without raising capital so frequently, the bank would not be able to maintain fast loan growth. Such growth will come at the cost of existing shareholders. In his eyes, the bank's fast growth helps justify valuation, which helps it raise more money, creating a loop of dilution that eventually eats into the shareholder value. The risk is that if profits don't ramp up fast enough, existing shareholders will own a shrinking piece of an expanding but still under-earning bank. So now who's right? Honestly, both sides have a point. Vaidyanathan's vision is clearly bold. In 6 years, he's turned a sleepy DFI into a full-service bank with a real customer base. The numbers on CASA, branches and deposits are impressive. The credit card and retail book are scaling. He said that this is how institutions are built. Raise the capital, then generate return on equity. Once you do that, it becomes self-sustaining. But the Twitter critique is important too. Constant dilution should never be brushed off as normal. Shareholders deserve to see value per share grow, not just the balance sheet. And right now, most of that balance sheet growth is being funded by fresh money, not internal profit. So is IDFC's first strategy bold long-termism or wishful thinking? See, the answer depends entirely on execution. If the bank gets to 15% plus ROE by FY27 as planned, the entire debate will look like early stage noise. But if ROE stays stuck in single digits and more capital is raised in 2026 or 2027, the skeptics will have been right. That's it for this episode. If you have any feedback for me, please let me know in the comments below. Real TV service.
क्या बोला?
But could structurally erase
अबे क्या बोल रहा है? पिलियल बोल.
and as he said and as
One eternity later.
and as he said, this kind of transfusion
एक काम कर 200 रुपए दे और 50 रुपए काट ओवर एक्टिंग की वजह से